The Intelligent Investor by Benjamin Graham is a timeless guide to making smart investment decisions. Graham emphasizes the importance of patience, discipline, and careful thinking rather than chasing quick profits. He introduces the concept of a margin of safety, encouraging investors to buy stocks at prices lower than their true value to reduce risk. Reading this book helps you avoid common mistakes, stay calm during market ups and downs, and make long term decisions that protect and grow your money. It's a valuable resource for anyone looking to invest wisely and build lasting financial security. Part 1, General Approaches to Investing. 1. Investment versus speculation. Results to be expected by the intelligent investor. Investing and speculating are two different approaches to managing money. Investing involves careful analysis where the focus is on the safety of your money and earning a reasonable return over the long term. An investor purchases stocks or bonds after understanding the company's financial health, management, and growth potential. The goal is to achieve steady, reliable returns without taking unnecessary risks. Speculation, on the other hand, is like gambling, buying stocks based on guesses, trends, or tips without proper research. Speculators aim for quick profits but often face greater risks and unexpected losses. Many people confuse speculation with investing, which can lead to poor decisions and significant losses. An intelligent investor avoids this trap by staying disciplined, patient, and focused on long-term gains rather than chasing short-term market movements. The key is to make thoughtful, fact-based decisions rather than acting out of emotion. By following these principles, you can avoid being swayed by fear or greed, remain focused on your goals, and make choices that protect and grow your wealth over time. Consistency with this approach helps build a strong foundation for long-term investment success. Number 2, the investor and inflation. Inflation is the gradual rise in prices, which reduces the purchasing power of money. As a result, the same amount of money buys fewer goods and services over time. Inflation is a hidden risk for all investors, quietly eroding the value of savings. Even if your money is sitting safely in a savings account or bonds, its real value may decrease if it cannot keep up with rising prices. Relying solely on fixed income investments, like bonds or cash savings, may seem safe but can be risky when inflation is high. To protect against this, it's crucial to invest in assets that have the potential to grow with inflation. Stocks of strong, well-managed companies are a good option because businesses can often raise prices to keep up with inflation, helping their profits and share prices grow. Real estate and certain commodities can also provide protection. Diversification, or spreading investments across different types of assets, is another key strategy to reduce risks. By balancing stocks, bonds, real estate, and other investments, you can better protect your wealth while still seeking growth. Understanding how inflation affects investments and taking steps to guard against it is essential for maintaining financial security in the long run. An intelligent investor stays aware of inflation's effects and chooses investments that can withstand it, ensuring wealth is preserved and grown over time. 3. A Century of Stock Market History, the level of stock prices in early 1972. Looking back at stock market history provides valuable lessons for today's investors. In the early 1970s, stock prices were at a high level, and the optimism among investors was evident. However, historical trends show that the stock market moves in cycles, with periods of growth followed by corrections or declines. In the 1960s and early 1970s, the stock market had experienced substantial growth, but the price-to-earnings ratio was reaching levels that suggested overvaluation, signaling potential risks ahead. This period serves as a reminder that rising stock prices can sometimes lead to bubbles, which may burst when expectations are too high. The intelligent investor understands that stock prices are subject to fluctuations, and overvalued markets may lead to sharp corrections. By studying the past, investors can avoid the pitfalls of chasing short-term market trends and instead focus on making well-informed decisions based on solid research and long-term goals. History teaches us that stock prices don't always continue rising indefinitely, and being aware of the cycles can help investors manage their expectations. In the long run, focusing on fundamentals and long-term growth is a more reliable approach than trying to time market highs and lows. Number 4, general portfolio policy. The defensive investor is one who prioritizes safety and steady returns rather than taking on high risks in search of higher rewards. This type of investor seeks to preserve capital while achieving a reasonable, consistent return over time. The defensive portfolio typically contains a mix of stocks and bonds, but with an emphasis on bonds and other safer, income generating investments. Bonds provide stability and help reduce the overall risk in the portfolio. Stocks, while offering higher potential returns, are more volatile and can expose the investor to significant short term losses. To balance this, the defensive investor selects high quality stocks in well established companies with a proven track record, which are less likely to experience drastic fluctuations in price. This conservative approach offers long term growth while reducing exposure to market downturns. The defensive investor is patient and avoids being swayed by market noise or emotional reactions to short term fluctuation. Rather than chasing the latest trends or speculating on risky investments, the defensive investor maintains a steady approach, focusing on building wealth over the long term. By carefully managing the portfolio and sticking to low risk investments, the defensive investor is able to achieve consistent returns without the stress or potential losses that come with higher risk ventures. This method offers peace of mind, especially during uncertain times, and serves as a safeguard against market volatility. 5. The defensive investor and common stocks. For the defensive investor, common stocks can be an important part of a well balanced portfolio, but they must be chosen carefully. While bonds offer stability, stocks provide the potential for growth. The defensive investor looks for stocks that are well established with a history of consistent performance and solid financials. These stocks typically belong to companies that have proven their ability to withstand market fluctuations and deliver reliable returns. It's important for the defensive investor to focus on large, stable companies that are unlikely to experience significant volatility. By selecting stocks in companies with strong management, solid earnings, and a low risk of financial distress, the defensive investor can benefit from the growth potential of equities while minimizing the risks associated with market downturns. The goal isn't to chase high returns or engage in speculative trading, but to make thoughtful, long term investments that will grow steadily over time. By allocating a portion of the portfolio to such stocks, the defensive investor can strike a balance between income generation and capital appreciation, ensuring that their portfolio remains resilient in different market conditions. 6. Portfolio policy for the enterprising investor, negative approach. The enterprising investor takes on a more active role in managing their portfolio, seeking higher returns by carefully selecting individual investments. However, this approach requires more time, effort, and expertise. The negative approach focuses on avoiding certain types of investments that tend to carry significant risks or offer poor returns. Rather than pursuing overly speculative opportunities, the enterprising investor looks for underappreciated or undervalued stocks, bonds, or other assets that have the potential for growth. This requires research, analysis, and patience, as the enterprising investor must be able to spot opportunities that others may overlook. The negative approach involves rejecting overly risky investments, such as those in companies with weak financials, poor management, or unsustainable business models. It also means avoiding trends or fads that may offer short term excitement but don't have long term value. The enterprising investor's focus is on careful, methodical decision making, avoiding the temptation to chase after the next big thing. By rejecting these risky, high cost investments, the enterprising investor can reduce exposure to unnecessary risks and build a portfolio that has a higher probability of success over time. 7. Portfolio policy for the enterprising investor. The positive side. The enterprising investor takes a proactive approach to managing their portfolio, seeking higher returns through careful selection of investments. On the positive side, this strategy involves identifying undervalued assets, finding opportunities where market prices do not reflect their true worth. The enterprising investor actively seeks out stocks, bonds, or other assets that have the potential for growth, typically looking for opportunities that the broader market may have overlooked. This requires a deep understanding of the market, company fundamentals, and economic trends. By staying informed and conducting thorough research, the enterprising investor can find hidden gems that offer higher returns than what is typically available through more conservative investments. The key is to identify undervalued or mispriced assets and invest in them before others catch on. This positive approach also involves taking calculated risks, but doing so in a way that is supported by evidence and analysis rather than speculation. By adopting this approach, the enterprising investor aims to achieve higher than average returns while remaining mindful of the potential risks involved. The focus is on intelligent decision making, value investing, and a disciplined strategy to build wealth over time. Part 2, the investor and market fluctuations. 8. The investor and market fluctuations. The market is constantly moving, and investors must understand how to navigate its fluctuations. Whether the market is rising or falling, it's essential to recognize that volatility is a normal part of investing. Investors who react impulsively to short term market movements often end up making poor decisions. Market fluctuations, whether caused by economic news, political events, or investor sentiment, can create opportunities or risks. For the intelligent investor, it's important to stay focused on long term goals and avoid being influenced by short term market noise. By maintaining a disciplined approach, investors can make decisions based on fundamentals rather than fear or greed. During market downturns, investors may find opportunities to buy quality stocks at discounted prices, while during market rallies, they must stay cautious to avoid getting caught in speculative bubbles. Understanding market fluctuations allows investors to manage risk and take advantage of favorable conditions, ultimately leading to more stable and successful long term investing. 9. Investing in investment funds. Investment funds provide an efficient way for individual investors to gain exposure to a diversified portfolio of assets, such as stocks, bonds, and real estate, without having to manage individual securities. These funds pool capital from multiple investors and are managed by professionals who have the expertise to make informed decisions on behalf of the fund's shareholders. For the defensive investor, investment funds can provide a steady return with reduced risk, thanks to diversification, which spreads the risk across a variety of assets. This helps minimize the impact of any single poor performing asset. Popular investment funds include mutual funds, which are actively managed, and exchange traded funds, ETFs, which are typically passively managed and track a specific index. Both types of funds offer an opportunity to invest in a broad range of assets and sectors. The key benefit of investing in funds is professional management, which saves the investor time and effort in selecting individual investments. However, it is important to consider the costs associated with funds, such as management fees, which can impact the overall returns over time. Additionally, while funds offer diversification, it is crucial for investors to understand the fund's investment strategy and risk profile before investing to ensure it aligns with their financial goals. For the enterprising investor, specialized funds may also present an opportunity to gain exposure to sectors or investment strategies that match their more aggressive approach to investing. 10. The investor and his advisors. Some investors prefer to rely on professional advisors to help them navigate the complexities of investing. An investment advisor's role is to provide expert advice and guidance, helping the investor make informed decisions about their financial portfolio. These advisors can assist with portfolio allocation, tax planning, and identifying opportunities to optimize returns. However, it is essential for the investor to carefully choose an advisor who has the right qualifications, experience, and track record to provide sound guidance. While financial advisors can bring valuable knowledge, it's also crucial for the investor to stay actively involved in their financial decisions. An intelligent investor should not blindly follow advice, but should understand the reasoning behind the recommendations and ensure they align with their own objectives. Transparency is important, as the investor should be fully aware of the fees charged by the advisor, as these costs can erode long-term returns. Additionally, some advisors may have conflicts of interest, so it's important to choose one who prioritizes the client's needs. The investor should also periodically review the advice and the performance of their portfolio to ensure that it remains aligned with their goals. A good advisor can be a helpful partner in building wealth, but ultimately, it is the investor's responsibility to take ownership of their financial decisions and ensure that the advice they receive contributes to their long-term success. 11. Security analysis for the lay investor, general approach. For the lay investor, security analysis may seem like a complex and intimidating task, but it can be broken down into simple, manageable steps. The general approach to security analysis involves looking at the fundamental aspects of a company, such as its financial health, competitive position, management, and future prospects. This analysis aims to identify companies that are undervalued in the market and hold long term potential for growth. A key element of the analysis is understanding the company's financial statements, particularly the balance sheet, income statement, and cash flow statement. These documents provide insights into the company's profitability, liquidity, and ability to generate cash. Additionally, the lay investor should focus on the company's earnings stability, its debt levels, and how effectively the company is using its assets to generate returns. It is also important to consider the company's position in its industry and how it competes with others. While the analysis may seem overwhelming at first, the intelligent investor can take a step by step approach, starting with simpler metrics like earnings, price to earnings PE ratios, and dividend yield, and gradually building up their understanding of more complex factors over time. By focusing on these basics and avoiding the temptation to chase market trends or speculation, the lay investor can make more informed decisions and develop a portfolio that suits their financial goals. Things to consider about per share earnings. Per share earnings. Per share earnings, earnings per share or EPS, are one of the most commonly used metrics for assessing a company's profitability. However, investors should be cautious when interpreting this figure. EPS is calculated by dividing the company's total earnings by the number of outstanding shares. While a high EPS might seem like an indication of a profitable company, it doesn't always paint the full picture. Several factors should be considered when analyzing EPS. First, investors should check whether the company's earnings are growing consistently over time. A single high EPS figure may be misleading if it results from one-time events like asset sales or accounting adjustments rather than sustainable business performance. Additionally, it's essential to consider the quality of earnings, not just the quantity. A company may report high EPS due to accounting practices or cost-cutting measures that don't necessarily indicate long-term profitability. Another consideration is the company's share count. Companies that issue more shares can dilute EPS even if earnings are stable, so changes in the number of shares outstanding should be taken into account. Lastly, comparing a company's EPS with its competitors or industry average can offer valuable context. By looking at EPS alongside other financial metrics like revenue, cash flow, and debt levels, investors can get a more complete understanding of a company's financial health and its true earning power. 14. A comparison of 4 listed companies. This section provides a detailed analysis of 4 different listed companies, comparing them to assess their investment potential. Investors are encouraged to evaluate these companies based on several key financial metrics such as earnings growth, profitability, debt levels, return on equity, and cash flow. These metrics help determine the financial health of a company, which is crucial for assessing its ability to withstand market fluctuations and sustain growth over time. The comparison looks not only at financial data, but also at the business model, market position, and competitive advantages of each company. For instance, some companies may have a long-standing history of stable performance, while others may be newer, with higher growth potential but also greater risk. By considering factors such as market share, brand strength, and adaptability, investors can gain insights into the company's future prospects. Additionally, dividend yield and debt management are crucial considerations. Companies that offer consistent dividends and maintain low levels of debt are generally considered safer investments, providing a steady income stream and less financial risk. Conversely, companies with high debt levels or a history of fluctuating dividends may be riskier, though they could potentially offer higher returns. By comparing these 4 companies side by side, investors can identify a line with their risk tolerance and investment goals. This analysis equips investors with the tools to make more informed decisions, helping them determine which companies are poised for long-term growth and which may be more suited for a conservative investment strategy. 15. Stock selection for the defensive investor. The strategy for the defensive investor focuses on minimizing risk while ensuring a steady, long-term return. Defensive investors prioritize financial stability, making stock selection an essential aspect of their investment strategy. This approach stresses investing in companies that have a history of consistent earnings, low debt, and strong balance sheets. These types of companies are often referred to as blue chip stocks, large, well-established companies known for their financial reliability and stability. A key component of stock selection for defensive investors is ensuring that the companies chosen have a proven track record of profitability and resilience, particularly during economic downturns. These companies often operate in industries with stable demand, such as utilities, consumer goods, and healthcare, making them less susceptible to market volatility. Defensive investors generally avoid high risk, speculative stocks, focusing instead on those that offer predictable returns and are unlikely to experience sharp declines in value. Financial metrics such as the price to earnings, PE ratio, and dividend yield are crucial in evaluating stocks for defensive investors. A reasonable PE ratio ensures that the stock is not overpriced, while a consistent and attractive dividend yield provides a reliable income stream. Dividend payments are often a sign of a stable, financially secure company with a solid business model. The defensive investor also emphasizes diversification to reduce risk further. By spreading investments across different sectors and industries, the portfolio becomes less vulnerable to downturns in any one sector. Overall, the goal for the defensive investor is to build a well-balanced portfolio of stable, reliable companies that can provide consistent returns over the long term with minimal risk. This approach helps to ensure that the investor's financial future remains secure, regardless of market conditions. 16. Stock selection for the enterprising investor. The enterprising investor takes a more active role in selecting stocks compared to the defensive investor. While defensive investors focus on stability and low risk, enterprising investors are willing to take on more risk in exchange for potentially higher returns. They actively seek undervalued stocks or companies with strong growth potential that may be overlooked by the broader market. This approach involves conducting thorough research to identify companies with strong earnings prospects, competitive advantages, and solid growth potential. Stock selection for the enterprising investor may involve looking at small cap or mid cap companies, as well as industries that are undergoing significant changes or have room for growth. Unlike the defensive investor, who may focus on well established, stable companies, the enterprising investor is often more open to investing in companies with higher risk but potentially greater upside. The key to success in stock selection for the enterprising investor is careful analysis and selecting stocks that offer growth potential at a reasonable price while still maintaining an awareness of the risks involved. Number 17, convertible issues and warrants. Convertible issues and warrants are types of securities that can provide opportunities for the enterprising investor to enhance returns. Convertible bonds are bonds that can be converted into a predetermined number of shares of the issuing company's stock. This option provides the investor with the potential for equity upside while still enjoying the fixed income benefits of bonds. Convertible bonds tend to be less volatile than regular stocks, but they offer the opportunity to participate in the growth of the company's stock price. Warrants, on the other hand, give the investor the right to buy a company's stock at a specific price within a certain period. These are often issued by companies to raise capital and can be seen as a way for investors to speculate on the future price of a company's stock. For the enterprising investor, convertible issues and warrants can be appealing because they provide a way to invest in a company's future growth potential with additional flexibility. However, they also come with risks, such as the company's stock not reaching the desired price or the bonds not being converted into shares. So it's crucial to carefully evaluate these options before investing. 17. 4 extremely instructive case histories. 4 case histories of companies are explored, each chosen for its ability to offer important lessons in investment strategy. These examples showcase both successes and failures, providing real-world insights into how companies perform under different market conditions. Each case allows an understanding of how financial metrics, management decisions, and market influences shape long-term outcomes. Companies from various sectors are included, enabling investors to gain a broader view of how different industries operate and how strategies affect performance. The case histories emphasize the importance of conducting thorough research to evaluate a company's financial health, growth potential, and competitive positioning. They also highlight the value of patience and long-term thinking in investing, showing how thoughtful evaluation and discipline can result in successful investments over time. By studying these case histories, investors learn from both the triumphs and missteps of others, giving them the tools to make informed decisions. These examples illustrate how careful, strategic decision-making can contribute to financial success in unpredictable markets. 18. A comparison of 8 pairs of companies. A comparison is made between 8 pairs of companies, all operating in similar industries, to provide insight into how businesses differ in their financial health and potential for growth. Key factors such as earnings, market share, profitability, and financial stability are examined to identify the strengths and weaknesses of each company. The comparison helps investors understand how market volatility, management choices, and business strategies impact the long-term performance of each business. Although two companies may appear similar on the surface, deeper analysis often reveals differences in how they are positioned for future growth or how they navigate challenges. This exercise in comparing companies provides investors with practical knowledge on assessing companies beyond basic metrics. It highlights the significance of strong management, innovation, and risk management in determining success. Ultimately, the comparison aids investors in developing a more informed approach to evaluating investment opportunities and identifying companies that are poised for sustainable growth. Part 4, Commentary on Value Investing. 19. Shareholders and management's dividend policy. Dividend policy is a key aspect of how companies manage their profits and interact with shareholders. The policy determines whether profits are paid out to shareholders in the form of dividends or reinvested in the business to fund expansion and growth. A company that regularly pays dividends signals to investors that it is financially stable and able to generate consistent cash flow, which can be a strong indication of solid performance. For shareholders, receiving dividends can be seen as a reward for their investment, offering them a direct return on their capital. However, some companies may choose not to pay dividends and instead reinvest earnings back into the business to fund research and development, acquisitions, or other projects that could lead to long-term growth and higher stock prices. In this case, shareholders rely on the future appreciation of their shares instead of immediate income from dividends. It's important for investors to understand how a company's dividend policy aligns with their own goals and risk tolerance. For income-focused investors, steady dividends might be a top priority, whereas those seeking growth might prefer companies that reinvest profits for expansion. A well-considered dividend policy that balances rewarding shareholders and ensuring sufficient capital for future growth is typically a sign of good management and a company positioned for long-term success. 2020. Margin of safety as the central concept of investment. The margin of safety is one of the most important and protective principles in value investing. It refers to the difference between a company's intrinsic value, that is, its true worth based on fundamentals like earnings, assets, and market position, and its market price. In simple terms, it's the buffer that exists when investors buy a stock for less than its actual value, offering them protection from potential errors in analysis or unforeseen market downturns. By investing in stocks with a significant margin of safety, investors reduce their risk of losing money even if things don't go as expected. If a stock is purchased at a lower price than its intrinsic value, the investor has a cushion that helps absorb potential losses in case of market fluctuations or poor company performance. The principle is based on the idea that by focusing on undervalued companies with strong fundamentals, investors can reduce the risk of speculative losses and make more informed, cautious investment decisions. This strategy involves avoiding stocks that are overhyped or trading at inflated prices, and instead focusing on companies whose market price does not reflect their true value. The margin of safety provides a sense of security, as it ensures that even if a company underperforms or the market becomes volatile, there is enough of a cushion for the investor to still potentially make a profit or at least avoid major losses. The principle encourages investors to prioritize preserving their capital while seeking investments that have a high probability of appreciating over time. Thank you so much for watching. Your support means a lot to me. If you enjoyed the video, don't forget to like, comment, and subscribe for more content. I truly appreciate you being here. See you in the next video.